Well, good morning, everyone. We're here for day 2 of our week-long webinar series as we hit 2021. So new year, new tax year ends. Obviously, again, as I said yesterday, 2 key dates in the diary for fund managers, for financial planners, and that's 31st of January and 6th of April. So we're doing these series of webinars to try and look at a different theme every day around EIS and SEIS and kind of the wider SME focus as well. And today, joy upon joy, it's fees and exits. So you can see in front of us, we have a very special panel again. We have Paul Mattick, who joined us yesterday. We have Zoe Chambers, who joined us yesterday. Rather than me to go through the whole panel, let me let them introduce themselves. So Zoe, I went first with you yesterday. I'm not going to go first with you today. Paul, do you want to go first?
Great. Hello, I'm Paul Mattick from Mercia. I'm one of the directors at Mercia Fund Management. We run both EIS fund, which we're talking about today, and the VCT, and we also manage various different regional funds for the government. Had some great exits, which I hope to talk about some of them today. And yeah, we'll talk about fees as well. But thank you, guys.
Thanks, Paul. I'm going around my Zoom screen. To my right is Andrew. Andrew, go for it.
Yeah, good morning, everyone, and Happy New Year. My name's Andrew Noble. I'm a partner at Power Equity. Power Equity is an early stage investment manager based in Edinburgh, investing across the north of the UK. We've backed over 61 companies to date since 2008, having realised now 22, and brilliant track record in returning money to investors. So delighted to join this call to talk about fees and performance.
Lovely job. Chris, you're next on my clockwise around Zoom.
Hi, good morning, everyone. I'm Chris Sanford. I'm the CEO of Co-Investor. We run a alternative asset investment platform specializing in tax efficient investments, and it's free to use for any advisors or direct investors.
Short and succinct. Thank you very much, Martin.
Good morning, Martin Crawley-Boovey. I'm a Director of Financial Planning at PK Group. We provide a range of services across financial planning, employee benefits, wealth management, accountancy and tax. We're about 60 people in total, with offices in Richmond, Kent and Woking. I'm here today to provide an advisor perspective to the panel.
Absolutely, the most important person here. And Zoe, last but not least.
Hi everyone, happy lockdown. Lovely to be with you all again. So yes, I am Zoe Chambers. I'm principal at Octopus Ventures. I'm sure lots of you are familiar with Octopus. So I'm part of the investment team that manages Titan VCT, one of the kind of largest in the UK, but we also have an EIS service which is newly launched. So here to obviously talk about that along with everybody else. And yeah, thanks again for having us, Mark.
No worries, thanks Zoe. I feel like we should have a kind of fine jar for anyone that mentions lockdown or anything along those lines, because yeah, day 2 of our webinar, but day 1 of lockdown, unfortunately, 50p in a jar for me. So look, we're here to talk about fees and charges today, and also exits, probably 2 of the most hotly debated areas within EIS and SEIS for financial planners, particularly at this time of year as financial planners putting their panels for EIS and SEIS together. So we're going to look towards how fund managers work towards an exit, kind of the steps they take, what the work they undertake with invested companies to get to that point, and what the process is, because I think it's important to understand, you know, we talk about 3, 5 year, 7 year kind of exit routes. I think it's important for financial planners to understand how that comes to be. But we're probably going to start with, we're going to turn our attention straight away to fees and charges, you know, what fees actually pay for within a fund, what steps they take to keep their proposition as lean as possible and as mean as possible. We've seen that across a lot of different financial products in the last few years that charges have slowly crept down as kind of innovation and technology has come along. So we'll see what's happening in our world and how that's kind of kicking through as well. So probably the best place to start is with Chris, because Chris has a kind of eagle eyes view of the whole industry and has done a lot of work on fees and fees transparency. In alignment with ourselves at ESA, we put out some fee principles recently in the last year or so at the same time. So Chris, perhaps you could give us a very good grand overview of fees and charges, the type of fees that are out there and what they're levied for.
Yeah, so we embarked on a project probably 6 or 9 months ago now, working with you, Mark, and the fund managers to really try and get that holistic overview of all of the fees out there, and we've built a fee calculator which is on our platform. I mean, the exercise was quite extraordinary in the fact that we uncovered, I think, 37 or 38 different fees across the industry. However, it's not quite as scary as that initial number sounds, because you know, more than anything is a terminology and standardization issue across the industry, with the different fund managers calling different fees different things. And when you break it down, there's actually much less, and you know, the fund manager with the most different fees at the moment, we think is currently running at 7 different fees. But there's you know, the fee calculator is put in place really so that anybody, whether you're a direct investor or an advisor, you can come on board and you can, you know, bottom line, you can easily calculate what the total expense ratio is of that investment. That's the number one, we think, the number one priority. What is that total expense ratio? What is it going to cost me? And then secondary to that, but also important, was who pays the fees. Is it the investor paying the fee, or is it the portfolio company? And that's important for a number of reasons. But the third element then comes into play, is how much of that fee is part of the subscription and is legible for tax relief. So there's sort of the, you know, the key elements of what we wanted the fee calculator to break down. I say we came up with 37 different fees. 5 to 7 would be normal for a fund manager. You know, it's expensive to run a fund. I'm sure Andrew, Zoe, and Paul can validate that. So fees are there for a reason. They need to be justified, but also they need to be transparent. And you know, I think what we found is, you know, the industry's always had this cloak where they don't want to be transparent. Actually, we found that's not true. You know, we embarked on this exercise, this sort of initially as a pilot with 10 fund managers, everyone very receptive. You know, the only thing really lacking was that standardization across the industry and the calculators that people can see the fees. So, you know, we're excited to be rolling this out across the industry. And I say it's all available on our platform.
Yeah, I've just put the link to our website on the chat, which gives the fee transparency. Chris, if you want to do the same with your calculator and put a link into the chat.
Yep.
I should also say at the start, if you've got any questions or if you want to add anything, we'll be doing some questions at the end, but there'll be a Q&A. So please do put questions in the Q&A or the chat, and we'll put those to the guys and girls at the end. Chris, the other thing I was going to mention was, you mentioned it was kind of those 37 fees that you've identified, 5 to 7 kind of is the average, and they're the most obvious ones. Could you just run us through what those charges are? So is there initial charge, AMC?
Yeah, I mean, charges? You know, there's probably three standout charges that everybody charges, and for understandable reasons. You know, there's the initial fee, so the initial investment fee, and whether that goes to the investee company or whether that's charged to the investor. There's then an annual management fee, which I think is very justifiable. You know, funds don't run themselves. And then there is the performance fee as well. So, you know, if we look at alternatives as a whole, you know, you have that traditional sort of 2 and 20 model. Here it's slightly different because there's such a broad array of fund managers, from very small niche specialist early stage managers through to the much larger managers, and there's actually that broad array here as well. But you know, ultimately, running a fund, there's a certain amount of expense that goes into running that fund. So they're the 3 sort of key fees, and then there's lots of other fees which we were joking before, actually, that we're not. I won't run through all 37. I did promise, but you know, there's board fees and deployment fees and all sorts of different fees then. But as I say, we've managed to standardize that in the calculator. But the 3 key fees are initial fee, an annual management fee, and then the performance fee.
Brilliant, thank you very much. So it's probably a good time to bring the fund managers on this one. So yeah, Chris has mentioned 3 fees there, and neatly we've got 3 fund managers, so it might be a good idea to speak to each of them on one of those. So Paul, for example, initial charges. What is an initial charge? How much is it generally? How much are yours? What does it cover in terms of what you're paying for?
I think Chris is probably a better person to say what is on average, but ours is normally 1%. I know a lot of funds are higher than that. which is fine, and we do charge various different fees. And as you say, the three different fees, the main three different fees, the initial, the AMC, and the performance fee, they cover different things, which we'll talk about. The initial fee is very much about finding due diligence, effectively. It's about the process of finding the companies. And for example, we're looking at about 3,000 companies a year, and we're investing into probably 1 or 2% of those. But the actual filtering process is very engaged and involved. I was on a call earlier today with a company doing an SEIS round, and we had an initial conversation with them. We probably won't invest in this round, but subsequently we might invest. And so we have the time of the management team, the directors who are looking at each of these companies, spending time with them, nurturing them, helping them before we even get into the actual due diligence. And that in itself has costs, and both external costs and physical costs, and our time associated with due diligence, and then there's investment committee time. All of this, it does add up to quite a significant amount. It does help when you're at a larger scale and you have a process which is slicker, and there's an economy of scale around that. So we're looking at our fees and seeing where we can reduce them appropriately. But and to be clear, we charge both to the investors and to the portfolio companies. I think the most important thing about fees is to be transparent about them. Then the advisors and investors can judge us on our performance versus the fees, rather than just the fees in isolation. Because certainly from our perspective, if you want to go with one of the top fund managers, they're all charging fees to the investors. So, and if you're not going with the top fund managers, that's fine, and you might get 100% deployment, and hence 100% tax relief, but you might not get the best investment outcome. And that's the balance. It's fees versus investment outcome.
Sure. Thank you very much. Zoe, I'm going to ask you about annual management charges. Generally, what is an annual management charge? What are you doing for that money?
Of course. So I guess headline, want people to take away from this, and I can talk about what we specifically charge on each of those three bases in a moment. But is that this isn't like picking public stocks, originating small private business deals, nurturing them through their lifetime, and then carrying them all the way through to a realization and a return of capital is properly hands-on work. That takes headcount, that takes effort, that not just takes running costs of admin, accounting and reporting and make sure like the shareholders know what's going on, but that is a real non-automated, not stock picking. That's real, effort from lots of people on the team. And you have to keep originating, because there is a limit. You can't just deploy all your money into the same assets. So, you will often kind of close a fund and then raise another kind of mini portfolio. And so the annual management charge, obviously, of course, covers our fundamental costs. So how do we keep that fund running? How do we ourselves kind of, pay for all of the overhead and all of the people that need to be there doing that? And how do we, keep close to our companies, look after them and take them all the way through that process? So for us, with our newly formed product, we actually took on a lot of advisor feedback in trying to put together the fee structure, because you'll hear from all of us here, it's something we all think about all the time, and we're trying to kind of be informed from the market. And so what we did with our latest EIS fund, which is kind of in its launch at the moment, is we have an initial fee, much like kind of Paul mentioned, it's 2% on the amount invested, but then we don't take any annual management fee at all. It accrues once the fund is closed, but we defer that until we have a successful, profitable exit. So that's just to try and completely align us, and that's on a company by company basis, not on a portfolio basis. So what we've tried to do is to say, look, we hear you, you don't want to pay for unsuccessful deals. It means that we might have to wait to get paid for 5 years, which we have the benefit of because we're a bigger fund. And if we were starting out fully, you wouldn't be able to do that. You kind of have to, you can't just be loss making forever, even though we're investing in the businesses doing that. And so, yeah, it accrues, and then we will only get a performance fee on profitable and successful exits as well. And that
keeps you incentivized to keep that company, obviously, hopefully profitable.
Exactly. So it's to try and make sure that as much as you can totally align that in terms of making each company drive towards a profitable exit. And don't get me wrong, whilst we will all talk about how we really want everyone to be a 10x from its initial investment, there is a time when you say, okay, that's not going to happen, but can we drive towards, you know, something which is beyond a kind of 1 to 2, because that's still a realization and that's still important. So yes, that's the way we kind of formulated that structure. And again, we talk about it, look, fees are necessary. We are doing a very hands-on job, and we should take into account, performance ultimately an outcome. But again, we should revisit what we are looking at all the time. And hopefully, again, with ours, we did that specifically talking to advisors.
Sure. So I guess we're already learning that there's many different ways to cut a cake in terms of how you charge your fees and when you charge them, et cetera, et cetera. So Andrew, I guess coming to you on the performance or the exit fees, what's your take on that? And Martin, I hope you're listening to all this, by the way. I'm going to come back to you after this one and kind of get your view on what you've heard so far. But Andrew, exits and performance hurdles.
Yeah, so, first of all, at Par Equity, we're delighted to support the work that ESA has done on fee transparency, and also co-investor in terms of the comparison work as well. We do think it's really important for the market to gain trust in what we're doing, that these initiatives have been launched and rolled out. So we're very supportive of that. I can talk specifically on exits, but I also think, you know, like the others, I want to talk more roundedly about Par's overall fees and how we've got there too. Because when we're considering our fee structure, it's not just about one particular fee and how that all comes together, because we, as an investment manager, are looking to provide a brilliant service to investors and a brilliant service to our portfolio companies. We are, at the end of the day, operating a two-sided business model, and we think it's only fair that we charge both sides for that work that we're doing. Specifically on exits, I can talk a bit more about sort of the principles of how Par Equity have approached it, Mark. So happy to pick up any questions on that. Specifically on exits, what we at Par do is we charge a 20% performance fee, which is inclusive of VAT. And that is one of our principles, that all retail fees should be inclusive of VAT because it's a retail product. That is charged on the whole subscription. Once the whole subscription is returned, 1.2 times money back to the investor. And we think that's important to position the fees in that way, because only once the investors got all of their subscription and then 20% back do we start to charge a performance fee. And that's the way that we approach it too.
Is that across the portfolio, Andrew, or per company?
That's across the entire portfolio. Yeah. And as I say, you know, that's part of a package of fees that Par charges. We're broadly middle of the market in terms of our fee structure, but the way in which we charge our fees represents the way that we operate as a manager, making sure we provide a great service to investors and a brilliant service to portfolio companies to get the best outcomes.
Brilliant. Thank you very much. So Martin, yeah, you heard what the guys and girls have said here in terms of initial charges and annuals and exits, et cetera, et cetera. When you're kind of comparing and contrasting fund manager fees, what are you looking for? Are you just looking for a race to the bottom? Do you just want the cheapest fees, or how do you kind of compare and contrast these things?
Okay, well, I think, you know, from the other panelists, there are three areas that stand out which resonate with our process, if you like, for choosing EIS providers. The first word is transparency. That's been mentioned several times, and it's a key part of our due diligence process, and what we look for is transparency. The limit of interest with investors on charges, and that essentially leads to making sure that the provider is incentivized to create good outcomes for investors. So I say those are sort of the three things that stood out from what the other panelists have said. We go through a due diligence process where myself and other directors of the business all contribute on a committee basis to choosing EIS providers. So we have, for instance, business expertise from Patrick Kennedy, our CEO, who's a business advisor and trained on an accountancy basis, so he's a chartered accountant. So he'll look at the business model that the investee companies and the EIS providers use in terms of looking at the commercialities, if you like, of the proposition, and whether the fees are, you know, commercial, fair, and lead to the outcomes that I've mentioned previously. Secondly, we have our tax director, who's head of tax, and she'll look at the tax side of things. And then finally, myself and also Dale Thorney, our compliance director. So I look at, I've got to, if I'm in front of a client, I've got to justify this investment and the fees to my clients, and they've got to buy into it. And so I've got to say, is this an investable proposition?
Yep.
Is this something that my clients are going to look at and say, well, that offers really good value for money? So I think
Sorry, Martin, I was going to ask, when those clients talk to you about fees, do they kind of push back and say, oh, that looks a bit ripe or a bit too much for me, and to the point that Zoe made also, that how do these type of fees compare to other investments at the same time? So obviously this is quite a manual, you're not just punching numbers here, you're not just tapping into a computer and seeing what kind of investments come up. It's a very manual process in that sense. So how do they compare to kind of other fees and charges that other investment vehicles have?
Yeah, I mean, there's always pushback on fees, I think, from clients, especially these days, and clients are getting more and more focused on fees. And we have to be more and more transparent, and we are duty bound to lay out all the fees and talk about the TER, which was mentioned earlier, and we had to put that into our suitability report. So we have to lay it bare in terms of what fees are charged, and so hence why transparency is so important. So I think, yes, you're always going to get pushback, but if you can demonstrate, especially with EIS, because there is significant value to be delivered through the tax incentives, but ultimately, we want to see a good, solid, professional investment mandate behind those tax incentives that can deliver good value and good outcomes for clients. And if you can demonstrate that to your clients, then I think that pushback can be dealt with quite easily.
Brilliant. Okay, and Chris, just coming back to you, we started with you, so probably a good place to finish with you in terms of charges. Again, listening to what the guys and girls have said here, and kind of looking across the market as you do, are you seeing kind of downward trends in fees or upward trends, or just kind of leveling out at the moment? What kind of trends are you seeing?
I think the broad industry as a whole, the trend is down, and the trend is down both for fund managers and also on the advisor side as well. We've seen pressures for I think a couple of decades now on fees, and I don't think this subsector that we're specifically focusing on now is any different. I think what is unique, and Zoe touched upon it, is the hands-on nature of investing in this space, which does incur significant costs rather than just picking public markets. So I think the overall industry trend is down, but what I'm seeing is that there's a broad array of fund managers, and most fund managers, especially the smaller challenger or niche fund managers, don't have a large fund, so they tend to they may charge slightly higher fees, I think, on average, but then they are niche players and they're operating in a smaller sector, so you need to weigh up a slightly larger fee structure to the strategy that they don't have deep pockets in their funds, so they tend to run a slightly a fail fast strategy with the investee companies that they have, but then they'll likely get higher multiples on backing the winners within that sort of smaller portfolio, and they'll charge appropriate fees to run that strategy, which is a slightly more expensive strategy than running a larger fund with a much larger portfolio. So on balance, I think overall fees are down, but there's a myriad of fees out there, but there's normally a very good reason for each different fee structure, and the largest fees isn't always the most expensive, I think, is probably the way I look at it across the sector.
Okay, there's a question come in. I'm going to ask you, but I think you all have one. Why don't all funds have performance hurdles? I think Par, Mercia, and Octopus all do. So again, Chris, I'll perhaps ask that question of you. Most funds have performance hurdles, I think I'm right in saying. Do you know of any that don't? And if they don't, why they don't?
It's not, look, I'm independent. We just run a platform that enables advisors and investors to easily build up a diversified portfolio across different managers, which I think is a very sensible thing to do. I can't really comment on the individual fund manager's strategy, apart from, we see where the flows are going. And I think performance hurdle is a very fair way of doing things. Andrew touched upon the rationale behind that. And I think the transparency and the fee calculator that we now have will show the different models, and the investor or advisor can make their own mind up as to what they think is fair and appropriate for the client.
I think that's a politician's answer. You got that one fantastically well. I think to come back on that question, I think it goes back to what I said earlier. I think every fund manager has their own way of cutting the cake, and some will take more of an upfront fee and less of a back-end fee, and vice versa. It's just how the fund manager particularly wants to take their fee intake. So look, we covered fees, we covered the fact that it's getting more transparent. I think is great. As I say, Chris and ourselves have done a lot of work over that over the year. So please do check out the website with fee transparency on our site, and please do check out the co-investor calculator at the same time. It really helps you to get an idea of not just percentages, but money and how much is being taken when you invest clients' money into particular funds. It's a really useful tool. So we'll park up fees and we'll move on to something far more exciting, which is exits, I think. So look, we're starting to see more exits. Part of my chagrin over the last few years is we see very few exits in our world. The EIS has been going for 25 years, and yet we're still not seeing as many exits as certainly I'd like to see, but they are seemingly starting to come through a little bit more. Paul, I'll go to you first on this one as the exit of the year for ESA Awards. You should have some experience. Is that a trend you're seeing pretty increasingly? I know you've had a couple of exits this year. Are they starting to kind of funnel through now much more than previously they were?
Last year, like 2020, was surprisingly busy in terms of M&A for Mercia. And I think that's partly due to, is COVID related in various different aspects. There are some big corporates who are trying to reposition themselves, and hence looking down to small companies to help them be nimble and move into new sectors. So that's an obvious move. We also have invested quite a lot of money historically in diagnostics, medical diagnostics, and actually vaccines. So those companies are of high value, and there's lots of interest, inbound interest into that space. The same in HR tech, which we sold a company in that space as well. So across the board, we've saw far more M&A approaches to our group in the last 12 months than we have in the previous 5 years, which is great. But I do think you're right that the EIS industry needs to start realizing money on a regular basis at scale. So we always hear about the amount of money coming into EIS being around 2 billion, but I really don't think there's been 2 billion exits per year in EIS, and that's something which in due course needs to change to create a more long-term, sustainable, effective asset class. So, but say one exit within an EIS portfolio, early stage EIS portfolio, can return an entire fund value, and they don't have to be unicorns either. So we sold a company called Clear Review in October. It wasn't actually the one that won the awards, but sold that for 8 times cost, and that returned 80% of the fund value in one go. So, and they've got another 10 companies or so within that portfolio, which for further upside. So we are investing in early stage, all of us actually. And if the companies do well, we are talking about 10, 20 times cost in some cases. And that's what's exciting about EIS, both from a tax perspective, but also from the lack of capital gains tax, but also from supporting UK businesses in this, the time of need. So it's pretty active at the moment.
Yeah, and I think on that point, in terms of supporting companies, I'll go to Zoe on this one, if I may. In terms of guiding a company towards exit, obviously, Paul talked earlier about the amount of due diligence you do to get a company into that portfolio. You invest in them. How do you guide them towards an exit? How do you know when the right time is to exit? How do you work alongside those entrepreneurs to get to that point?
Great question. So what I would say is it's something that you start thinking about scarily early, but sensibly so. So again, in the interest of transparency, you will often set the expectations with an entrepreneur that you are investing in to say, look, from a fund perspective, our goal here, just so we're all fully aligned, is to return at least 10 times on our initial investment here. So this is when you're checking your ambition levels are aligned, that what they want to do with the business is aligned with you. And, that's a great place to start from. Then, much like everybody else, you have such a close relationship with this business. You are, we're valuing businesses kind of every quarter, but of course, from a board relationship, you're probably speaking to your CEOs kind of at least once a week, which means the ups and downs you will be suffering through. Now, typically we talk about, timescales, particularly in the earliest stages, and often in like the deeper, harder technologies being a bit longer and needing patient capital, so 7 to kind of 10 years. But of course, it's about timing, windows of opportunity, market changes, and kind of being alive and ready to that. So I think for me, it's a continuous understanding of the market, of your competitors, how you're positioned, knowing who your acquirers are. So we really encourage early conversations. And this isn't to try and be like, buy me. This is more to be like, what's your strategy? How might we fit in? Often a commercial partnership or someone who's a customer can end up being an acquirer. And so it can often be quite a long process of engagement, although I did sell a business last February, which ended up being like a 2-month turnaround, which was unbelievably quick. But again, it was because we were able to be alive to that as an opportunity and to say to ourselves, well, do we think that we want to invest more capital because we think there's an even bigger outcome if we wait, however many more years, or is actually now a really good time because the amount that we're going to return at this point is actually fantastic. And so it's a continuous thought process, conversation, market awareness. And so we will also ourselves say, well, if we're starting to see, and this isn't just great things, but if we're starting to see indications that perhaps another funding round isn't going to come together, or that the business is not going to be a 10xer, but might be a 3 to 5xer, we will again start to have very candid conversations with the entrepreneurs about what that looks like and who the buyers look like. It's not always going to be an IPO. I mean, in fact, in London, it's kind of very rarely. It will be a trade sale. It might be a PE roll-up. There's lots of different avenues to realizing capital for the earliest stages of investors. It might even be, that there are future funding rounds and it goes on a really big scale-up journey, but you get a secondary, so you can get some of the returns back for your earliest folks. I think one thing we do pay attention to, of course, is the impact of tax reliefs. The 3-year window does sit there. Unfortunately, again, you don't always know when these are going to come in, and sometimes you have an amazing offer and it's 2.5 years in and you're like, can I really go back to that acquirer and be like, could you just hold off for like a few more months? We are tempted, but obviously not. So I think, look, again, in the manner of rolling your sleeves up and really knowing those businesses, understanding the whole landscape, how it's continuously changing, and being that interface. It's another job that we do. We spend our lives as well talking to corporate development people and trying to kind of understand what assets they might be looking for. That's what we're doing, and that's a big part of our jobs, that continuous engagement.
Yeah, and you mentioned the 3-year qualification for EIS there. Obviously, in the dim and distance past, a lot of the EIS would say, 3-4 years, you'll get or 3 years and a day almost, you'll get your money out. But now, thankfully, most IMs talking more about a 5-7 year kind of timeline. Is the 3-year more of an irrelevance these days in terms of the companies you're kind of guiding towards an exit?
Look, we're technology first, and in the deeper tech, that's often kind of R&D heavy, and that does need to be very patient, and that can take longer. I mean, I say that you will often see acquisitions almost the earliest pre-revenue stages for the technology in the team. So, like when Google bought DeepMind, they weren't making any money, and so that can often happen. So you can get this kind of very early, we've spotted an asset, let's get in there type of acquisition, or you can go through a number of funding rounds and then it just generally grow. But again, that's when you really don't want to sell out almost too early. But I think what we often are balancing is taking some risk off the table, taking some money off the table through that journey if there are future funding rounds, and then kind of continuously thinking about the upside that can be built. So I don't think the 3 years is an irrelevance, but what I do think is, whilst we're continuously thinking about it, we don't always know when there's going to be a bite. Like, we can't assure advisors, our shareholders, anyone when an acquisition is going to happen. And so, it might well be, kind of 2 years, 4 years, 7 years. It's just about making sure that they're in the right place at the right time for when those bites do happen.
Yeah, and I guess that's about being transparent with investors about when that opportunity might come. As I say, it might be 5, it might be 6, it might be 7 years, but it's just letting financial planners and their clients know when that opportunity might come, which I guess brings us to the question that Nick asked on the chat. Very long question. I'm trying to summarize it quickly, Nick. I see Andrew's kind of partly answered it already, so thank you, Andrew. But I think if I'm looking at your question, it's around kind of transparency of exits, actually, about how you as a fund manager can guide financial advisors and let them know when exit might occur, and also around valuations and about how certain you can be on valuations. So I'm just trying to get your philosophy on valuations, I guess, Andrew.
Yeah, certainly. So the question from Nick is completely fair. I mean, at the end of the day, there's no point investing into EIS, despite all the tax relief, unless you're going to see your money coming back and then some. So what is really important is, managers who are able to, find the right companies, help them grow, and then take them to profitable exits. And that's what this game is all about. So at Par Equity, we're really pleased with the performance we've had so far, both across our EIS funds and all of our investment activities in general. I mentioned we've now realized 22 companies. That covers 136 investment rounds. And across all of those, both good and bad outcomes, we're achieving 3.8 times money back to investors before any tax relief. So these are really, really good returns. The way that we approach it in terms of the way that we manage the investors' expectations is that we tend to hold the price at the last investment round, and we will only sort of change that price unless there's a new investment round that comes in and prices that business accordingly, or if the business has faced some sort of material adversity such that we need to write the holding price of that company down. And so what investors quite often experience at Par Equity is that they will see their holdings not tick up all that much over a number of years. There might be a follow-on funding round, it might tick up a little bit, but then actually the real jump in value comes on an exit. And on average of the exits that we produce, we generally see an uplift of 3 to 5 times money on an exit from the last funding round or the last price that we had against a company. So my sort of advice to investors is do be patient. If you are working with the right managers, we will give you as much insight as we can into the deals. But the real uplift in value will come when an acquirer turns up and they want to buy that business and they want to put a value on that business to make, to take it off our hands. And so there is an element of patience required in this business.
Yeah, absolutely. It's probably a good time to bring Martin in on this one as well. I guess having heard what the 3 fund managers have said there, Martin, does that kind of resonate with your experience? And also, when you're talking to clients kind of around exit levels and exit timing, what messages do you give to clients at that point, or can you give to them?
Yeah, thanks, Mark. Essentially, yeah, since the patient capital review, I mean, pre-patient capital review, I think, you could be reasonably clear about timeline and expectations on exits. Clearly, since the review, that's changed significantly, and now I think you've got to deliver a much more diversified range of assets. So across several different investing companies and several different EIS providers, and throughout that range of assets, those range of investing companies, you're going to get different exit outcomes. And I think you've got to take clients through those outcomes, from actually, well, some are just not going to survive. They're going to lose money. And then you explain the loss relief that you can claim as a result of that. So I think you've got to take investors through every single potential outcome. Even if you get sort of early stage exits, and effectively within 3 years, you could potentially lose your tax relief. So, there's a range of potential outcomes that investors could experience, and the key is therefore to build up a diversified portfolio of EIS assets, like I said, across different providers. But in terms of timeline, I mean, you mentioned 7 years as being something that they should be thinking of, and I think overall that's fine. But if you do take a portfolio approach, then you should see a range of different timings on exits, and hopefully, right through that portfolio, you will deliver the returns that the other investment managers today have mentioned.
So it's pretty much a case of trying to set clients' expectation levels when they first invest, I guess, as much as anything else. I guess in our game, the problem is the lemons ripen before the plums, in the fact that you get a lot of failures before you get the big exits that we talked about, further down the line. So I guess that's hard to take as a client, that you're immediately seeing perhaps write-downs or money lost, in the hope and expectation that further down the line you'll see an exit.
Yeah.
And how does that work?
I think that's important from a valuation point of view, to be clear, and client reporting is key, because if clients can see some of the companies doing very well, then the losses, the early stage losses, they can accept more easily.
Sure, and I was going to kind of follow that with, I don't know if you do cash flow planning or not, but is it easy to work this type of investment into a cash flow model?
Do we? Yes, indeed. Yes, we certainly would. ISs and VCTs and business relief investments, we all include that in our cash flow planning and cash flow forecasting tools.
Is it easy to work in terms of, obviously, the exit might be in year 5, or it might be in year 7, or it might be in year 8? So
yes. Well, you have to be clear about the assumptions, that the assumptions are only assumptions, and the reality of the situation may not be the same as the assumptions used in the cash flow planning.
Sure. Okay. Brilliant. Okay. So, Chris, coming back to you, just on exits. So again, kind of, I guess you see kind of across the market here. Are you generally seeing more exits? Certainly, when we were perhaps 2 or 3 years ago. Is there a trend?
Yeah. I think that's fair. And I don't know. I don't know how much of it is, as Paul touched upon, there has been an increase in M&A activity, from a large corporate sort of strategic perspective, which totally makes sense, as well as, a little bit of maturity in the EIS industry with regards to, there's a lot of fund managers sort of 3 to 5 years ago were starting to make these investments, and we're starting to see some of these come to fruition. So we are seeing multiples increase, exits increase, and I think that's just a combination of a number of different factors. I think Andrew touched upon a really interesting thing just now as well. There is the issue with looking at is the failures come first, and if you are doing a fairly fair valuation model where you're only valuating the portfolio on an exit rather than an arbitrary number, then your portfolio is going to go down before it goes up, and that can be a tough sale for the industry. But across the board, we're seeing more exits with some very decent multiples as well. So that's really encouraging, that the sector as a whole, and there are some standouts within that. There is good opportunity here for investors.
You mentioned there a decent multiple. What do you classify as a decent multiple?
I think it depends on the fund manager's strategy, because you have the smaller fund managers with the fail fast back a winner strategy, and then you tend to have the larger fund managers. And apologies, Zoe and Paul, I'm sort of brushing with a broad brush here, but where they do have deeper pockets and can run more companies across smaller exit multiple strategies. So I think it's dependent on the fund manager. Anything 8 to 10 is brilliant, and that's you expect across a balanced portfolio. Three times is fantastic in this sector against any public market strategy. But we've seen a number in the last six or 9 months that have been in triple digit, actually. So there has been some fund managers that have backed some really big winners. But that shouldn't be the strategy. That should be the windfall that you may occasionally get investing in this strategy. I think three times should be fair, and I think all of the fund managers here are at least trying to get that. Actually, I think, Paul, with your branding behind you, you say that somewhere.
Indeed.
You're very observant. I guess it's a bit like with fees we talked about earlier. It's easy to kind of race to the bottom and go for the lowest fee, but at the same time, you could have a race to the top in terms of exit multiples. I read a lot of IMs, you know, some say 3 times, as Paul does, for example. Some say 10 times, some say 12 times, sometimes 15 times, and there's a kind of whole range in between that. I guess it's difficult to work. Andrew, you got your hand up in a school classroom fashion.
I'm not going to ask her to go to the loo. I do have something to say though. I think in terms of expectations on returns, I think advisors and their clients should be aware of what market standard expectations are. And when you look at the UK venture capital scene as a whole, average IRRs are around about 13%. That is up a little bit over the last 3 or 4 years in particular. It's historically 25-year returns in VC have been around about 10%. When you look to the US, average VCs are around about 15% IRRs. And so, you know, when you look at a time scale, you know, and Paul's got the sign behind him, 5 to 7 years at a 15% IRR really means a 2 to 3 times capital before any tax relief. And I think that should be what most managers are targeting and trying to achieve for their clients, because that is respectable. Obviously, it's a benchmark return and not a target return. We always try and correct analysts when they use that definition, because at the end of the day, our target return is much more than 2 or 3 times money, and so far we've been doing that.
Brilliant, thank you very much. It's 1:45, so it's probably a good time to go to some questions, and we do have some questions to run through, so let's do that. Martin, there's one here. I doubt you have done this, but have you compared your client's 7-year EIS and VCT return versus 7 years in an S&P tracker? I'd be very surprised if you have, but if you have, it'd be good to hear.
I can't say we have. No, I'm not going to say we have, because that to me they're completely different investments.
Like I say, it'd be an unfair comparison.
It's like comparing apples with pears. So no, we haven't done that comparison, unfortunately.
That covers that one up. Thank you very much. There's an interesting one about down rounds. Actually, it's probably a good question to ask the panel. Down rounds obviously do occur. How do you kind of factor those into your investments and the companies that you're following? Paul, I'll go to you for that one.
Sure. So of course, down rounds do happen, especially in the last year. There's been a lot of challenges, and I think we've been quite lucky in our portfolio, and there's been some good uplifts actually. But we do see down rounds on a regular basis, and not everything goes to plan initially, and there might be plan B, plan C, or things just get delayed. So, and then the pricing is appropriately reduced in the next round. And the way Mercer invests is that we put small amounts in first and then follow with larger amounts. So we would expect to follow subsequently if a company's doing well. If companies are not doing quite so well, we have in some cases, when they're not doing well at all, we probably wouldn't invest. And when there's a middle ground, we may invest at a lower price. And then at that point, that pricing is taken across all shares, which I think it's industry standard that happens. In addition, there's also the option we take to take provisions. So if we see there's a risk, so we took some provisions against COVID, which a provision is a reduction in valuation. It might be 25 or 50% of the holding value. If it's appropriate, then we will take provision against that company, just so that investors, it might not have been around recently, pricing it at any level, but we think it's not going so well. So in those cases, we do actively reduce the valuation of those holdings. So I think certainly the down round pricing is valid, but also people take provisions as well, and we certainly do.
And I guess at the moment with COVID, you mentioned that we went almost 46 minutes there, but I mentioned COVID. But I guess with COVID, well, would a company's not doing well at the moment, and you say there might be a down round or you might not invest at all, is it harder at the moment to make that decision, whether you kind of just pull the plug and say that company's done, or do you take into account the kind of the wider situation, take into account that obviously next year, hopefully, will look very different to this year? Yeah,
well, we always try and take a longer term view. And actually, we're lucky to be able to utilise some of the government support schemes, both the future funds, the biggest one which we've been using recently, as well as the C-bills, etc., and furlough, the portfolio companies. That enables them to extend over this period and hopefully survive. And then when things open up again, they might be in a sector that directly benefits from reopening. But actually, quite a few of our portfolio companies are in kind of life sciences, e-commerce, SaaS, gaming, digital, so games consoles and things. They're actually doing pretty well during lockdown and the last year. But there are some specific companies, it's got to be looked at on a company by company basis. So some companies will just be able to survive in the current environment. We had a company which was doing social media feeds for scoreboards at Twickenham, and they were getting paid per game. And of course, there's no games, so there's no social media requirements. And that's an unusual situation where it had a multi-million revenue just dropped to zero straight away. That business model no longer works. Whereas there's kind of the middle ground where it might be either marginally negatively impacted by COVID, and then it's more of a position where we kind of reduce, try and preserve some cash in the company, might look for government support schemes. And if we think there's a way which they can pivot into a different sector or different trade, which is less affected by COVID, then we would potentially support that as well. So, but there has been challenging times across the industry, and there are, subject to which company and which sector, there are some companies which are benefiting, but there are some which have been absolutely decimated.
Yeah, it's a tough time, absolutely. Zoe, there's one more question I was going to put to you. I noticed you said your dog might make an appearance, and I can see her in the background there. So the question is about our lockdown again. How does the lockdown process impact due diligence and access to new investments, and in turn to exits?
Yeah, really good question. So I think we've all become very familiar with meeting management teams over Zoom, which is new and has been much longer and is slightly strange, but that is just the new norm. So I think one of the folks mentioned earlier that, you know, we are engaging with kind of thousands of businesses a year. And whilst there was probably a mini hiatus last March, while we all just kind of sorted out our portfolio and tried to get our houses in order, it's very much business as usual. We still want to invest and deploy our capital, and we still want to meet these businesses. It does mean for us that due diligence has certainly taken far more time on Zoom. So I've now done like Zoom coffees, beers, and normal things with management teams. So we have like virtual site visits, people coming in and out. So probably what I would say is slightly longer, but you know, what we have seen, because we've been investing, is you can still do the job, which is fantastic, and thank God to technology that we can do that. Exit wise, what I would say is that it's made everybody very accessible. So as I'm sure you are all experiencing, actually, that now that you're at home all the time, you don't really have a reason to not be taking some of these calls. And certain businesses where they have been forced to almost halt what they are doing are now looking around at M&A opportunities or at how technology could get them back on their feet. And so whilst they can't do their latest project or do BAU or run at breakneck speed, they are now open to, you know, tech companies either engaging with them on a customer basis or on even a future kind of acquisition basis. So we as VCs, I think I've had far more conversations with kind of corp dev folks at big corporates than I've ever had, again, because they're now like, okay, well, I'm sat at my desk all day. Let's kind of do an outreach and kind of meet each other like this. And equally, I see our startups getting far more airtime than they probably were before, again, because people are accessible, both of which are great things when I look forward to this year. So diligence process probably quite, a little bit longer, but we're getting used to it now. So now it's the same. Exit opportunities and availability of folks to engage more with early startups has actually been, I think, a very positive trend. I'm loving this. Someone's just commented, we sold a business entirely remotely with a site visit done by FaceTime. Exactly. And that is exactly right. We've deployed, so my mini team, we've done kind of 4 new investments in the last kind of 6 months, and it's unheard of. You know, I say to some of the CEOs, I'm really looking forward to meeting you in a park at some point, and that's life now.
Yeah, exactly.
Yeah, and then I'll meet them and I'll be like, oh, you're very tall, which is a very strange thing for your investor to say as the first thing they say when they meet you. But what I would say is the market really is kind of roaring, and whilst folks have kind of hunkered down and revised their plans and, you know, made contingencies for the next 18 months, I think both new capital coming in and also kind of acquirers, it's busy. So I think the year is going to be very, very interesting.
Yeah, let's hope so. On that note, it's probably a good place to kind of finish up in a succinct way and I'm trying to have a bit of a success story. Perhaps the pre-fund managers could to talk us through, and I'm going to limit you to a minute each because we've only got 5 minutes left. Just give us an idea about an exit that you've got hopefully coming or in the pipeline, if you can talk about it. I just want a bit of good news, basically, to hear about and some of the companies that are doing well in your portfolio. So, Andrew, I'll go to you first.
Yeah, absolutely. So one of the companies that we like to shout about is Current Health. It's technology as a force for good. They do remote patient monitoring for hospitals and care homes. They have simply a best-in-class product that they provide their customers with. So they can basically allow hospitals to send patients home early. They can be monitored at an ICU grade level in the comfort of their own home. And the business has effectively built an iPhone that what is an operating system on your arm. So other wearable tech devices can build into that and make it increasingly sophisticated over time. So the likes of Dexcom, for example, have now integrated their glucose monitoring devices into the Current Health solution as well. Current Health is a company that's based out of Edinburgh. It's now selling to hospitals all over the world. They were also responsible for monitoring patients during the Oxford AstraZeneca vaccination trials. The business is going absolutely gangbusters. We're very, very excited about it, and we have high hopes for the future of that company. And that's obviously just one example of a portfolio of 39 companies.
That's your minute up. Thank you very much, Paul.
Right. Yeah. So last year was quite successful for Mercia. We sold, I think it was 6 businesses, 5 at over 8 times cost, up to 13. But historically, we've sold a company at 104 times cost as well. But actually, looking forward, we're in the final steps of selling an EIS business at hopefully around 20 times cost, and which is hopefully another entry for the Exit of the Year award. That's the plan, and hopefully be done by tax year end. So we'll hopefully have some more conversations about that in due course. I can't give too much detail away because it's not done yet, but it's looking good. And yeah, watch this space.
Watch your space. Good place to end. Zoe, over to you.
Yeah, so off the back of last year, we have just closed, we sold Calistone to Carlisle, which was 18 times our initial cost, 9 times over the total investment, Siemens to Ultrasoc, and which I'm not allowed to disclose, and we got Pop to Entertainment Partners, which was 5x in 3 years. Our EIS service is going to be a co-investor with our VCT, which means that it's going to have access to follow-on rounds in some of our most exciting businesses. One of which that I will talk about is a business called Depop. Any of you who have teenage children or one apparently during lockdown, they have grown particularly during lockdown as folks want to buy and sell their vintage goods online, and it's a kind of social network as well, so lots of liking and commenting on each other's things that they're selling. Now has kind of 30 million users globally. It'll have $1 billion worth of GMV as of the end of last year. They took $70 million from General Atlantic a year and a half ago, and actually having originally been a European business, over half their revenues now come from the States. And given that lockdowns don't appear to be going anywhere, and I am definitely getting fined all of the pounds for saying the word lockdown.
Oh, don't worry, I've clocked it all down.
Times in the sentence. It's a business we're still very excited to carry on backing.
Oh, brilliant. I see Jodie mentions that her kids use it as well. So
seriously, I know. I'm so happy that everybody, well, when I say I'm so happy, it's one of those things that you're like, if you want to know any of them, you'll either see Kazoo, which is like on football shirts, or your kids will use Depop and be making and selling money on it. So it's good to reference.
No, that's good to know. It's good to hear it's all going well. And Martin, because we've got a minute left, and there's a question that's come through from Nick, and I'd like you to answer it if you may. So it's going back to his point earlier about the S&P. Obviously this is all about making money eventually for clients. That's the end goal for all of us, let's be honest. So if the S&P is performing well and has new innovative entrepreneurial comments on it and it performs better, why would you bother with EIS and VCT?
Well, that's a good point. The only thing is you've got to, I think, look at EIS in particular as a tax incentivized investment. So it might fit and be suitable for a particular given set of client circumstances. When we always recommend an EIS or a VCT, we always we require our clients to self-certify sophisticated investors and high net worth individuals and sign a risk warning. So it's only a very, very speculative few of our client universe who will be eligible for EIS or VCT investment.
And Chris, you had your hand up. Do you need to talk
in terms of the comparison,
sorry, Martin,
just quickly, in terms of comparison, we have done a comparison on business relief investments with the more mainstream type markets, because we feel that's a fairer comparison, if you like.
Makes sense. Yeah, I see what you mean. That's a good point. Chris, yeah, you're going to mention something.
Yeah, I do have some strong views on this. Look, you know, for 20 years, I was involved in asset allocation, and I set up and run my own sort of global asset allocation business. Look, I think when you look at the public markets and look at the S&P 500, yeah, it can look very attractive, but I think the important thing here is to have an overall diversified portfolio, and whether that's public markets and then obviously fixed income, but the alternative market space is very interesting. It should be part of a diversified portfolio. The issue with alternates historically has been access. And I think the EIS market has opened up access to a broader amount of potential investors. Obviously, the platforms, not just ours, but platforms then enable people to build a diversified portfolio within that alternative space. But I think if you look at this sector and alternatives against the S&P 500, I think it works very well as part of an overall diversified portfolio. You don't want all of your money in the S&P 500. You don't want all of your money in fixed income, because that hasn't done much for the last decade. I think this is it's an exciting space, but it should be as part of an overall diversified portfolio. The important thing is now you can access some really interesting fund managers and some really interesting companies using technology. You haven't been able to do that before. You can now build a diversified portfolio. Obviously, I'm not proposing that you take all of your money out of the S&P 500, but I would recommend having a diversified portfolio, whether you're an individual investor or whether that's advised money. And I think we now have the technology and the fund managers to enable people to do that. So.
Thanks, Chris. Yeah, I think that's a good message to end on. So thank you very much for kind of putting that across and answering that question. So look, just leaves for me to say thank you very much to all our panelists for offering their views and thoughts on fees and exits today. We just clicked past 11:02, so apologies we're a little bit late, but thank you for bearing with us. Thank you for asking all the questions as well. If you do want to learn more about fees and fees transparency, I'll put the link to our website on there to have a look at what we're doing, and I'm sure Chris will send out a message in due course about the co-investor link and looking at the calculator at the same time. So thank you very much to our panelists. We'll see you again same time, 10 o'clock tomorrow morning. Thank you.
Thank you.
Thanks a lot.
Thanks, everyone.
Thanks, Martin. Thanks, Chris.